Let's do the numbers. In a nutshell, U.S. stocks ran amok in light of COVID-19, dropping 20% in the first quarter. Small companies dropped further, down 31%. International stocks suffered as well at a 23% loss. There's a reason we call bonds the lower risk investment because they rose 3%, ameliorating the returns in balanced, diversified portfolios. The S&P reached a low point in late March and has rallied a bit from there. Why? We've had great monetary support from the Federal Reserve Bank and solid fiscal support from Congress. Businesses, organizations, and people are pivoting on a dime, embracing the digital, ordering online, delivering curbside, and struggling to march on. Jeffrey Kleintop, one of Schwab's pros, had sound insights back in February. We don't know how far down markets are headed, but we have an idea how many quarters of corporate earnings will likely be impacted. First quarter earnings got slammed. We are seeing that this week. Second quarter will be ugly. Hopefully, if the CDC and government leads well, earnings in the third quarter can start moving up. There appears to be consensus among the pros on this point. The question then is, how much economic activity, how many businesses get decimated, unable to be revived as we move through this? The Federal Reserve Bank has swung for the fences, dropping short-term interest rates, restarting QE programs to push cash into the economy, lending to financial institutions, backstopping money market funds, commercial paper, and municipal bonds. They're expanding repo operations to ensure functioning markets, buying corporate bonds for the first time, offering loans to businesses and to state and local governments. We are talking trillions, not billions. Congress has pushed through the CARES Act for another $2 trillion in emergency relief to individuals, small businesses, healthcare entities, and to state and local governments. Your $1,200 may be winging into your bank account as we speak. Congress is working on another bill for infrastructure and accoutrements to send in more fiscal spending. How much GDP gets clipped in the first and second quarters is unknown. The projections from respected experts continue to vary widely on this point. First quarter earnings season is just starting this week, and those with good news like to report first. We're seeing that. Businesses are refusing to give guidance on their earnings for upcoming quarters, though, citing too many unknowns. We may be stuck with unknowns for another month or two, so we should expect markets to swing and manic depressive investor sentiment. What do we know? We know that we'll come out the other side of this pandemic. Then we can start opening up the economy with baby steps over 2 or 3 months in some low-risk areas. We'll fine-tune that process as we learn. Don't forget that markets usually look and price for 6 to 12 months down the road. Reviving third quarter earnings are a real possibility. What positive steps can we take? We're using tax loss harvesting to offset capital gains on future tax bills. We've already halted some 2020 required minimum distributions for clients who have other cash sources, and that will lower their 2020 tax bills. We've rolled back in 2020 RMDs that some clients took early. Most clients are delaying plans for large spending, an excellent strategy to avoid pulling money out at the bottom. We're continuing our planned purchases of bonds and stocks in portfolios that have cash. Financial assets are on sale after all. There's more. Converting an IRA to a Roth for your children, refinancing your mortgage or HELOC if you can catch a low enough rate, gifting securities to beneficiaries, and selling portions of concentrating holdings are more strategy to consider. What's most important as an investor? Oh, I wish we had a crystal ball to foretell market tops and bottoms. But barring that, it's still best to diversify and balance among different investments, use solid research, and follow proven investing strategies.